Hi there, Etoro. It is Monday the 7th of March, and it's time to take a look at what moved the markets last week. Now, quite a lot has been going on, so I wanted to walk through some charts very quickly as a way of illustrating that. So on top left, we have the Russell 2000, so mid-cap, small-cap companies smaller than those in the S&P 500 in the US, and you can see that from the beginning of this year, these have dropped 12%, quite a lot in the past two trading days, excluding today. You can also see that since the high, they're down 18.5%, and that was back in November. Before this, these companies, this index, or this ETF, had been trading in a range, so these types of companies haven't had a great time, and that's because people run away from small companies when there is a large amount of risk perceived in the market. Top right, we have the FTSE 100, and the index has recovered somewhat today, but at the time when I drew this, it was down over 10%, so in correction territory from the middle/beginning of Feb. Obviously, the last two candles last week were enormous red candles, and these hit my portfolio quite hard because I have 10 or 12% of my portfolio devoted to UK companies. It wasn't just UK companies, obviously. Here in the bottom left, we can see that the German index has also taken a hammering, not just in the last 2 days of last week, but in the couple of weeks before that. And Germany is closer to the Ukraine, but also the ties with Russia and Ukraine are a bit deeper than the UK. Germany is also a manufacturing economy in general, so a large number of auto manufacturers have their headquarters in Germany, and those have been hit particularly hard by the conflict. The Nasdaq 100 on the bottom right, so the biggest 100 tech companies in the US or public companies have been hit since November, and it's not in a bear market anymore, but the last 2 days of last week were also quite tough there, so down nearly 17% since November, or since the beginning of this year, really. On the flip side, we have commodities that have been on an enormous run. So the price of wheat since the beginning of the year, well, the wheat futures here are up nearly 50% since the beginning of the year. Oil, I don't have any kind of indicator of the percentage gain here, but you can see the parabolic rise on the far right. It is slightly funny in these trying times to look back and see that the price of oil was negative, and people thought that it was going to be, a negatively priced asset back then. I mean, imagine going in with everything you had at this point. But also that's a good reminder that the market can be highly irrational in both directions. So just bear that in mind. Now, the price of commodities have been driven by the perceived scarcity of wheat. So I can't remember the exact percentage, 10 or 20% of the world's wheat comes from the Ukraine and Russia. I'm not sure of the exact statistic. Let me change that to a lot of the world's wheat comes from out of the Ukraine and Russia. Russian oil is popular amongst markets in good times. But the price of gold has also been rallying, not because of its scarcity, but because of its desirability as a safe haven, as is the US dollar. So these two are off of their recent highs from earlier today, but you get an idea of where the market's mind is at the moment. Over the past few weeks, the three things that the market has been concerned about have been inflation, rising interest rates across the world, but particularly within the US market and what they mean for stocks, and more recently, the conflict between Ukraine and Russia. Now, somewhere in the background has been a fourth concern for, I would say, probably a few months: stagflation or a recession, one of those two things. Now, with the sudden increase in commodity prices, the concern about a recession is growing more and more. And so on screen, I have the US 10-year yield minus the US 2-year yield. So this is a version of the yield curve, and just so that you know, every recession in the US has been preceded by an inversion of the yield curve for the past 50 years. But what we should also note is that not every yield curve inversion has resulted in a recession. An inversion of the yield curve means that the long-term rates within the market are no longer higher than the short-term rates in the market. So in the normal operation of the market, this is a great article, by the way, if you want to read an explainer about the yield curve. So the normal operation of the market, this is what the yield curve looks like. So these are the different maturities of the debt that you would be buying. So 2 years all the way through to 30 years. And the longer the duration, the longer the term on that debt, the higher the interest rate that you get in normal times. However, as uncertainty increases about the future, what we tend to see is a flattening of this yield curve. And then what can happen beyond that is that short-term rates become higher than long-term rates, and that is called an inversion of the yield curve. As an example, you can see here that leading into the great financial crisis, leading up to 2007, the curve flattened. It started to invert at this part of the curve. And then as the world made its way out of that major calamity and expectations were for growth, once again, the curve started returning to normal. Now, once again, we're not there yet. And there have been a few times in history where the yield curve has begun to invert and there's been no recession. The curve returned to normal and everything was okay. But this is one indicator that I'm watching closely, in particular because at the level of inflation that we're seeing around the world now, people have been looking back at history to see how high levels of inflation have been fixed. And it looks as though historically, in recent history at least, the only way that high inflations have been fixed was for there to be a recession that drove inflation lower. So now that note about historical inflation has become a concern given the increase in prices of commodities, which could thereby drive higher inflation, which could thereby drive higher rates, which could thereby drive a slowdown in various economies around the world, and therefore a recession. So now we have a fourth concern. I just wanted to highlight the size of the movements in capital that we saw last week. So European stocks saw their largest outflows on record. European stocks last week had their worst week since March 2020. People are also saying, when are we going to get a wider bear market? Well, in various areas, the bear market is already here. Look at the NASDAQ composite. So this is the superset of the NASDAQ 100. It contains more companies. Percentage of stocks down 20% or more from their 52-week high, 75%. Percentage of stocks down 50% or more from their 52-week high, nearly half of them. The indexes themselves aren't reflecting the reality because there's been a rush to safety, and big name companies are considered safe, but beneath the surface things have been ugly for a while. Maybe I don't need to reiterate this point anymore, but obviously we are now in extreme fear when it comes to the stock market. This is quite a nice little gauge by CNN. Read through the little breakdowns, which are quite interesting too. Now that is a lot of bad news, a lot of blood red charts, a lot of drawdowns in indices and major stocks around the world. Fear is high. So what should we be doing? Should we be terrified and afraid too? Or should we be sitting back and looking at the data? It wasn't that long ago, towards the end of 2020 and the very early days of 2021, when the market felt like you could not lose. Anything that anyone bought went up. Valuations did not matter. People were gambling with money and all sorts of things and making huge amounts of cash. There was FOMO everywhere. And it really felt like, it was going to go on forever. But, it doesn't. Inevitably, the party ends, the punch bowl is taken away, and stocks begin to drop. Some fell sharply, some have dribbled down over more than a year and a half. And now we find ourselves in the opposite place. If you go onto Twitter, if you look in various publications, you'll see that everyone just about is a bear at the moment. People are terrified. They're hedging as much as humanly possible, which tells me that we're now at the opposite end of that spectrum. Instead of buying everything at the top during the euphoria, you probably should have paused and reflected. And in the same way, right now, when we're at peak fear, it's not the time to be selling. It's the time to be looking at the wider market and trying to see what opportunities there are. And there are many opportunities. I just wish I had a huge amount more money to get into the market. All right, so what has created this fear? Well, I think we all know it by now, and I mentioned the 4 different areas of concern across all of the major, fairly trustworthy publications. You'll see the major headlines are about the war and the various impacts of the war, increasing sanctions and increasing prices of commodities and the fallout that we might expect from those. What about macro data out last week? So these were almost completely lost in all of the other headlines, but there was some good data out of major economies, so fairly strong PMIs. Most PMIs are still above 50, which means that those economies are still in their expansionary phase. CPI number out of Europe was a little higher than was expected, but by the by, this data wasn't what the market was really looking at. This week, it's a little bit quieter when it comes to macro data, but I believe that people will be watching this core CPI number, inflation number out of the US quite closely, and that's on Thursday. And the GDP number out on Friday will be closely watched. Expectations for growth in the UK economy are very small, so it'll be good to see what actually happened. Last week I mentioned that one of the most anticipated things through March will be this meeting with the Fed roughly in the middle of March. So in this meeting they will talk about their policy for the coming year. Everyone is very interested to see if changes in prices of commodities, the Ukraine war might affect their hawkishness. Will they become a little bit more friendly when it comes to markets? My gut feeling is they're probably going to stay their course and wait for more developments, but we will find out for sure next week. And finally, I wanted to end with this chart. There's a lot of bad news out there. There are a lot of red stocks that have been dropping for a year plus. A lot of newish investors that are frustrated, that haven't been through this type of event before, and a lot that will just be throwing in the towel. My portfolio on Etoro took an absolute beating towards the tail end of last week because I hold growth stocks and also some European stocks. But the companies that I own are good companies they've got a foothold. They've found their product market fit. They're making a huge amount of revenue, and in most cases, they are profitable businesses. I'm not a macro trader, so I'm not trying to trade in and out of the various headlines and goings on at the moment. I think that is quite risky given how fast things are moving on the ground. I think it is far less risky to hold good quality companies for the long term and let them compound their value for me. Now on screen, I have the stock price history for the ARK Innovation Fund. Cathie Wood has taken a lot of flack over the past year and a half or so, but I wanted to highlight one thing. I don't agree with everything that she says, and I don't agree with a lot of her picks, but I agree that her mission is the right one. So over the next decade or 2 decades, every company in the world will become a technology company. There are lots of companies out there already that are doing fantastic things, that are changing the world, and winning companies, when it comes to business at least, continue to win, even if their stock price doesn't reflect the value of that business right now. The reason I wanted to pull this chart up on screen is that Cathie Wood's ARK Innovation Fund has dropped 63% from its high in Feb 2021. Despite that, if you had bought into her fund when the fund opened, you would still be well ahead of the S&P 500, nearly doubling the return. I don't know if you can see that on screen. So the S&P 500 for that same period has given a return of 114%, whereas the Innovation Fund has given a return of 195%. Invariably, investing in even high quality, high growth companies ends up being very volatile. But if you have the experience to choose the right companies and you have the patience and discipline to hold on to them, you will end up massively outperforming the market. All right, that's it for this week. I know it's been a very tough year for investors basically across the board. I know a few macro traders have done very well, particularly those that have invested in commodities through the past couple months. Outside of that, I think almost everyone has taken a beating. Stick with your process, be disciplined, be patient, and in the end, you will do well. All right, thank you very much. Speak to you soon. Goodbye.